Welcome to Financial Focus, brought to you by GulfCoast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have been providing North Florida savers and investors sound, comprehensive financial guidance for over 30 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
And welcome into another edition of Financial Focus, brought to you by the best of the best in financial services, as named by the readers of the Lake City Reporter, 8 years and running, celebrating 30 years in serving North Central Florida savers and investors and achieving and accomplishing your financial goals. Ladies and gentlemen, they are the team from GulfCoast Financial Services, and founder and CEO John Kuykendall here with us each and every week to provide some insight and guidance on some of the complex financial issues, to simplify them and bring them down to an easy to understand and manage level. Now, John, that's not always an easy task, and the subject for today's program, no exception. It's everything that these rising interest rates are impacting. And I guess to start, it's been a while since we have seen interest rates increase.
Well, interest rates, Peter, have been down for a long time. I mean, going back to 1992, 1993, one-year CDs at the bank were 610, 620. So, we have seen that interest rate drop. It has caused a lot of savers to have to switch their investments because, prior to that, you could get a pretty decent return at the bank. And then the Fed has lowered interest rates, which has driven down those interest rates. And so savers have had to kind of punt. Now we're seeing the reverse, but, we're seeing a lag in the banks actually raising their rates because they have a lot of loans at lower costs that haven't matured yet. And so, if they've been borrowing money from the Federal Reserve System, then they have to pay more for that as rates go up. The key is the Federal Reserve System. The Federal Reserve System has a mandate to do two things. One is full employment. And after COVID, we lost a lot of employees, and they haven't come back to work. 4.1 million was the last number I got. And so that was a large number of people. The other thing is they have a price mandate to keep inflation in check, keep prices stable. And their goal is 2%. That's what they've determined, that a 2% growth in the cost of goods that you have to pay for year in and year out is where we should be. And as you know, this year, we've seen double-digit inflation. And so the Fed Fund has had to raise interest rates in order to try to curb some of that inflation.
Yeah, well above that 2% goal we have seen over the last year and a half to 2 years. And so the Federal Reserve stepping in with the tools that they have at their discretion. Basically, they are also tasked with controlling the currency in circulation, the monetary supply. They can buy or sell bonds, and they can set that key interest rate, which, John, as you mentioned, is the rate at which banking institutions can lend money. And banks aren't nonprofits. They are there to try to make a positive rate of return themselves. So if the rate at which they can borrow money increases, then therefore, also does the rate at which they lend it out. And so we have seen some pretty sharp increases in loan interest rates if we are financing our mortgages, our vehicles, or just about anything else where we borrow money.
Well, the banks have to raise their rates because they're being charged more for their money. And so that Fed funds rate, as we talk about, is the way the Fed controls money. It's the money. It's the interest that will be charged on money that they borrow from themselves. But also, a lot of corporate debt is based on prime plus. So it's the Fed funds rate, which is usually tied to the prime rate, and then plus a percentage. But as you said, we've seen, because of this Fed funds rate increase, we've seen mortgages go up to 6.5%, 6.75% during this cycle, and will probably go higher. And that that limits the amount of house that I can buy because it costs more for my interest rate and my principal payment. And so I can only afford, based upon my ratios, a certain amount of house. It's also taken a lot of houses off the market because people, we went through this cycle, Peter, where we were selling and buying. I could sell my house, cash out, go buy another house, keep it a year or two, sell it, cash out, and move forward. That's all stopped now because interest rates being so high, nobody's buying, and where can you move and get a better interest rate than what you've got?
Yeah, it's not that there won't be moving and relocating, but now it is going to be out of necessity rather than out of ability to get into a bigger and larger house at the same or cheaper monthly payment, or because we can refinance down to a lower rate to get a lower payment. So it really has stifled a good part of the housing sector of the economy with these rising interest rates.
Yeah, and with that, you get the bank lending. They're charging higher rates on consumer loans. Car loans have gone up. So, eventually there won't be as many cars bought because people can't afford to pay the higher interest rate. They just don't qualify. You'll see a lot more foreclosures and a lot more repossessions as time goes on. But, the one thing the Fed can do is they print money and they set the interest rates because they're the central bank. And as you said, they do that by buying and selling bonds, treasury bonds, in the open market. Now, you got to remember, too, that the government, because they're paying for these interest rates on the government bonds, they're having to pay more interest on all this debt we've got. Mm-hmm. So it's really a catch-22 for us as consumers.
Yeah, I saw some scary stats, and I don't know the exact numbers. It's been a while, but it talked about the fact that if prevailing interest rates rose kind of just a nominal amount, that just the interest on servicing the national debt would become a pretty large chunk of our total annual revenue and tax money going just to service the interest on that. It really has turned the housing market, though. And what we were seeing as a very strong seller's market with buyers kind of lined up around the corner, willing to pay well above asking price, has maybe turned, and I wouldn't say it's either a buyer's or a seller's market in this environment, John, because we are paying more on that interest. I mean, what we could get a $500,000 home for at 2.5%, we now are paying a larger monthly payment for a $350,000 home.
That's right, Peter. And there for a while, right after COVID, we had a situation where people were coming in and they were wanting to relocate to what we call free states, the states that had less restrictions than the other states, the northern states, California except as one. But they wanted to get away from those states. So they were willing to sell their homes in those markets and get a lot of money out of them because they'd lived in them a long time, and then come down here and pay any price to get a home, which it seemed like a steal, but it really wasn't. So it was driving our cost up. And then you get the COVID buildup on lumber and all the building supplies and the lack of labor, the fact that now we're having to pay more for labor. Houses naturally cost more. Yep. And so you're seeing the average home, which, used to be in the $100,000 range, now is in the $200,000 range. And those houses are getting harder and harder for middle wage people to afford because of their consumer debt. A lot of them have a lot of consumer debt that they built up, automobile loans in the past, credit cards, et cetera. So all of this is coming home to roost as we raise rates. But in order to get away from that double-digit inflation, the Fed almost has to do this. It's the only tool they have at their disposal that can try to cut back consumption and cut back the demand on unnecessary. I mean, we're always going to buy food and the things we have to eat to live on, but it's going to take away the discretionary money, the TV money, the large screen TV, the extra car, things like that.
Well, and Jerome Powell, the Fed chairman, has said that he understands that this will cause some temporary, possibly prolonged pain in the economy and in the market and in the pocketbook of Main Street Americans, but that he's willing to do that because inflation is an even larger source of pain. They have said that they are targeting a rate of around 4.4% as of the last statement that I heard from Fed Chair Jerome Powell. So not quite there yet. And speaking of construction that you mentioned, John, while the cost of some of those materials has come down, renters have been paying a premium simply because of a lack of inventory of available homes on the market because things were so hot and overpriced for so long. Well, yes, the price of construction materials has sort of come back down, but developers and construction finances their projects as well. So now, in order to finance that large scale construction of those new neighborhoods, they are borrowing money at a more expensive interest rate and premium. And therefore, we are not seeing the pace of new construction increase and therefore maybe rent not going down like it should.
Well, that's right, Peter. And you know, if you look at financing a $500,000 home at 2% is less expensive than financing a $350,000 home at 6.5%. I mean, the interest cost just costs more. Now, you know, traditionally, historically, if we go back when I purchased my first home in 1971, and when I purchased my last house, now I've refinanced it several times, but when I purchased my last house in 2004, we were paying in between 7.75% and 8.5% for every time we moved. I moved 4 times and I never got below 7.5% interest. So people are spoiled, and it's actually driven up the cost of our homes and the house that we think we can afford because of the low interest rates. I mean, you know, we went through that zero interest cost in the 2008 bubble, and that caused a lot of that problem because people were buying a lot bigger homes than they could ever afford, and especially when the interest rate gets turned on. And so now we've driven the price of these homes up. Now, if you're on an adjustable mortgage, your interest rates are going up. You know, they'll go up every year as long as we keep these interest rates high. Yep. So there comes a point when, you know, a lot of people may be hurt because of these adjustable mortgages.
Well, the housing market, obviously one large area of the economy impacted by these rising interest rates. Not the only area, however, John, we are seeing reaction in the market as well. Now, I want to put the stock market to the side for a moment because while it's more exciting and grabs more news headlines, it actually is a much smaller market than the bond market. And the bond market is having a historically awful year due to these rising interest rates. Can you talk about bonds, how they relate to interest rates, and why we're seeing this terrible performance for 2022 in bonds?
Well, this is the worst year ever for bonds. I mean, I can't picture a year in the past where we looked at bonds and looked at bond mutual funds and seen them 12 to 17% down negative. You usually think that if the stock market's down, the bond market will be up, and it'll be a safe haven until the stock market comes back. What happens is interest rates go up, kind of like a teeter-totter. If I've got bonds on one side and I got interest rates on the other side, as interest rates go up, my bond prices go down. And as interest rates go down, my bond prices go up. So if I've got a bond that's at 6%, it's worth more to me than a bond that's at 2%. And so what happened right now is we have a lot of low-cost bonds that are still in these portfolios that are still out there. And if you bought an individual bond, you know, when you buy an individual bond, it gives you interest rate for a period of years. And then if you hold it to maturity, you get what we call par. and that's 100 cents on the dollar. So if you bought a $10,000 bond at the end of 10 years, I get $10,000 and I've got my interest all along. However, in this market, if I had a $10,000 bond, it's going to be priced below par, which means I'm going to lose money on it because the interest rates are so low. We have to discount it to get back to the current interest rate. So as interest rates continue to rise, these bonds are going to be worth less and less. And so it's kind of a catch-22, Peter. And that's why bonds are in such bad shape this year. And I cannot find a bond fund that's making money. I mean, everyone I've looked at.
Now, if we do have the actual physical bond and wait till maturity, we still do get that par value back plus the yield or interest rate. However, correct. John, more and more investors do not own actual individual bonds. A lot of the bond or fixed income side of the portfolio, that side that has been traditionally considered the more conservative side of the portfolio, is actually in bond style or fixed income style mutual funds, which behave differently without a maturity date.
Right. Well, bond mutual funds, what we're doing is I'm buying a bunch of bonds and I'm putting them into a portfolio. So I may have interest rates from all over the place. And the reason we do that is because I get diversification of interest rates. I get diversification of maturities, and I don't have all my bonds maturing at one time. So theoretically, I should be getting a better price because I've kind of priced that into the market as it goes. However, that's not working this year. And because we've had bond yields have been so low for so long that we're just taking a beating on bonds, Peter. But bond mutual funds, I like them, or bond ETFs, because I can get out of them theoretically without losing that par. If I've got one bond, then I really am subject to interest rates in the market for that bond if I want to sell it. And so if I've got a 2% bond and the market's 4%, I'm not going to get a dollar for dollar back.
How difficult is this, John, for investors when we see the more conservative side of the portfolio in bonds and fixed income having its worst year ever? I mean, New York Times cited bonds' worst year yet, and then Forbes had an article in September. Same thought in the form of a question. Is this the worst year ever for bonds? How difficult is that for investors on whole, especially more conservative risk profiled investors?
Well, for them, Peter, it's devastating. For anybody else, it's also negative because, we go to bonds when the stock market's off because it will give us a yield. And in this particular case, we haven't been able to go to bonds because they're not a safe haven right now. And so if you're drawing money out of your account for retirement, you can't afford to be investing in a bond mutual fund or in a bond that's declining in value. It won't keep up with it. And so we're not able to get the gain out of the stock market. I don't have a safe haven to go to like I have in the past. And the problem is that banks haven't caught up yet with the increasing in price. They're still paying below market for their CDs and their money market accounts because they've got loans on the books that are extremely low, and they arbitrage between the interest rate and the loan rate. So they want to make as much as they can just to cover their overhead. So it's really a catch-22 for conservative investors. And we have to be careful, Peter, that we don't make a mistake, that we don't get greedy. We have to be patient. All of this will correct itself in time, but it's just going to take time. And I know if you're drawing money out of your account, you feel pressure to do something. But in this particular situation, Peter, I'm not sure what you do.
Yeah. Well, I guess if there is a silver lining to all of this, John, even though they have not kept up quite yet, and certainly over time have not kept up with inflation, we should see some improvement on the interest that we are earning in those bank style saving, checking, money market, and CD accounts, correct?
That's right. We will see that eventually. Now, the fixed annuities, not the fixed index annuity, but the fixed term annuities, those are actually keeping up pretty well and have some decent yields for people who are willing to tie their money up for 2, 3, 4, 5 years. There are some yields there that are much better than the banks, but the banks haven't kept up yet, but they will eventually get there. It's just going to be a matter of time.
On the other side of the coin, though, less and less of us are savers, unfortunately, and equally as unfortunate, more and more of us finance life through debt. So from everyday purchases to vehicles, we've already talked about the mortgages, but using that credit card, we are going to be paying more for any and everything that we do finance.
Well, yeah, and we're going to be paying more for everything anyway, because inflation has seen to that. The new wage laws, which slowly raise us up to $15 an hour in most states. I mean, all of this is compacting everything we're doing with the stock market and everything else to create this perfect storm of where we're having to pay more for goods, more for interest, more for our consumer debt, but at the same time, we're not being able to earn enough to keep ahead of it in our investment accounts.
I saw a speech by Warren Buffett, who is a pretty well-known and very successful investor. He recently said that if he could earn a rate of return equivalent to what credit cards charged in interest, that he would have no desire to even take the chance and risk of investing his money. He'd just sit back and collect the interest on the debt that he issued. And I'm sure some of his businesses probably involve that to some extent. But yeah. If that tells you anything about the interest rate on credit cards, I think kind of across the spectrum, anywhere from about 12 to 26% interest rate on that debt that you carry over on your credit card. So certainly one area where these rising interest rates are going to impact. Now, John, the stock market does receive much more attention and news headlines than the bond market or credit card interest rates. And we have seen a shakeup in stock market prices and values this year. Is this impacted by these rising interest rates? Is that why we're seeing this market volatility?
Well, that's one thing. I think so far this year, we've been lucky that the companies have been continuing to make profit. And the downturn in the market has been because of the anticipation of the Fed raising rates. Now, the reason we have that anticipation in the market is, as the Fed's raised rate, as we talked about, debt costs more, borrowing costs more. Companies, these large companies, borrow a lot of money for their investment, for their R&D, for all the things that they're expanding in. And so that therefore affects their profit. And I think we're just to the point now, Peter, where we're going to see some of the companies coming out in the near future are going to be reporting lower earnings than they had last quarter, because this is finally impacting them. The fact that higher cost of goods, higher lending costs are all impacting their bottom line or impacting the demand for their goods. And so, yes, it's a double whammy for them because, one, the market has been anticipating this, but once it starts happening, we're still going to see more downside than upside.
One final topic that we wanted to be sure to hit on as part of our discussion of the impact of rising interest rates, John. This one may not affect a lot of people, but the people that it does impact need to be aware of this and pay special attention. And that is that if you are entitled to a pension from your company, rising interest rates could actually impact some of your pension options.
Well, yeah, Peter, that you don't really think about that. When we talked about that earlier, I had never really thought that rising rates would affect the pension. But what we have to figure out is these companies, when they do the pensions, they are the buyouts. They figure out how long your actuarial life is, your life expectancy, time the amount of money you're going to get. If I'm earning 6% on my money, it's going to take less. I'm going to be able to give you less money than if I only earn 4%. So the buyouts and the pensions will be lower, especially the buyouts, because if I'm giving you a lump sum, I'm going to be able to give you less money for the same amount of good that you had before. I never thought about that, Peter, but it's something that people should think about. And if you're able to take a lump sum, 2023 may be the year that you need to take it before 2023 as these interest rates continue to rise.
Now, that doesn't necessarily mean you need to run out and announce your retirement date early because, John, that may be difficult given what we've already talked about in the stock and the bond market environment that we are in. But any decision on a pension needs to be made very carefully on an individual basis and with all the information. And as part of that information, simply to be aware that these rising interest rates may impact the lump sum option that you have on the table and may, in fact, decrease the lump sum that you are being offered.
Yeah, and certainly, Peter, you should contact your human resource department and actually get a figure on how much your lump sum would be. I'm not suggesting that we all take it, but on the other hand, you're leaving dollars on the table. It's something you need to understand, be aware of, and then make an individual decision as far as which way is best for you. But I didn't really think about that until you brought it up when we were talking. It's a good point, something that everybody should be aware of, and something that everybody should take advantage of.
Well, again, if you would like to take a look at your financial plan, retirement plan, your investment allocation, your outlook for your timeline and achieving benchmarks, milestones, and goals into the future, pick up the phone and give Gulf Coast Financial Services and John Kuykendall a call, 386-755-9018. That's 386-755-9018. On the surface level, we hear rising interest rates. We may even in certain conversations hear interest rates are improving. But obviously, as the discussion on this program indicates, wide-spreading impacts of interest rate increases. Not all of them are positive. We need to understand the full implications. We have been in a historically low interest rate environment for a long, long period of time. And now suddenly these interest rates are adjusting rather quickly upwards. And that does have impacts on many aspects of your financial life and outlook. John, I appreciate you shedding some light and perspective on all of this and the important information that you share each and every week here on Financial Focus.
Thank you, Peter. It's great to be here. We'll look forward to seeing you next week.
Once again, ladies and gentlemen, if you would like to speak with the team at Gulf Coast Financial Services, if you would like your own financially focused written retirement income plan, pick up the phone and give Gulf Coast Financial Services a call, 386-755-9018. That's 386-755-9018.
Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities, Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through Gulf Coast Financial Services, Inc., a registered investment advisor in Florida. Gulf Coast Financial Services, Inc. is not affiliated with Kovac Securities, Inc. or Kovac Advisors, Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors, including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.